This is Satya Pradhuman of Cirrus Research. Our quarterly outlook is just out. In fact, our conference call will be held next week. This dispatch, the title is Risk Capital at Risk. Tightening credit drives an earnings-driven market. At the heart of this is really something we framed out pretty much all year under the title of a barbell strategy. And what's behind this is this sort of like a conflict really between the profit cycle slowing and the reality that commodity prices are higher for longer. And so there's a lot of moving parts here, but a couple of things that have been fairly consistent is the idea that if you're in a world of interest rate risk, which we clearly are, high multiples are going to get punished. And so this idea of the break in innovation shares we've all really talked about and we've been really focused on for over a year now. This has really it's really run its course. We've seen a lot of damage take place at the most innovative, the most aggressive growth stocks. In addition to that, the reality is that the profit cycle is indeed peaking. And as a result, it is an earnings-driven market, which is generally a lower returns market. But at the end of the day, a higher quality bias matters. I'll show you some of the ebb and flow in that, but at the heart of this barbell strategy, I think it's held well year to date. It's given us the ability to really get exposed to commodity groups and at the same time focus on quality and limit our valuation risk. As much as there's a lot of moving parts, I think the two things we can focus on is rate risk and the profit cycle slowing. As a result, in terms of the portfolio strategies we've put in place, across the board, whether we're in the growth camp or in the value camp, we've definitely been more on the valuation sensitive side with a GARP framework or a quality growth model. And on the other end, clearly a quality value skew. Either way, I think it gets us to a much better stock selection world. I think one of the takeaways from this report, though, is that instead of a stock market, I think we are moving now into a market of stocks. And I think it's a nuanced statement, but I think, and I've borrowed it, I'm sure, from somewhere. But at the end of the day, what's gone on is that we've really punished speculation. We're now bracing for the profit cycle to slow. This curve here represents, the purple line represents the peaking of the U.S. profits curve. The blue line represents the earnings expectations starting to roll over. But again, I don't think we're there yet. So what we may end up seeing is much more of a downward guidance in this upcoming season. And in addition to that, what we've noticed is that the quality skew, high quality skew has worked really well. Part of this is a bit overstated because what it's really saying is low quality stocks have gotten hammered and the spread, of course, looks favorable. We've had a bit of a pullback in the third quarter this year. As we saw low quality reaccelerate, we had a few dead cat bounces along the way, some move in commodities. But I think if you look through this, we're just at the beginning of this wave. The other fundamental risks that we did not have a year ago are that credit spreads are about 400 or 500 basis points higher. That's massive. And as a result, it doesn't necessarily tell you you're going into a recession, but it certainly is a focus on profitability and quality balance sheets. So I think our thesis about a barbell strategy is going to hold fairly well. It does get a little exciting here as we get to the year end, just because we've had so much damage. I've got to think we're going to get some of these sort of like dead cat bounces to follow as we get into the seasonals here. Take a look at the report. Again, our conference call is next week on Thursday. Please join us. As always, if there are any questions or comments, we are happy to take them. Thank you.